Welcome to It's the Economy. Brent crude prices have fallen for the second straight day despite lower than expected US inventories. Now, this could be because of subpar purchasing managers index numbers that are flowing in from Europe, Britain, Japan and the US itself. In any case, at the moment, more than the data, all eyes are on what Fed Chair Jerome Powell may say at Jackson Hole, which is, of course, the annual meeting of central bankers at Jackson Hole. If Powell is even mildly more hawkish than expected, yields and the dollar can jump and commodities like oil can face the repercussions. To understand the nuances of the crude market and the US economy, I have with me someone who is proficient in both, Daan Struyven, who leads oil market research at Goldman Sachs, and until recently, he co-led the Goldman Sachs Global Economics team as well. So, Daan, thank you very much indeed for joining us. I want to come and ask you a lot of questions on the US economy and what is expected from Jerome Powell. But before that, you are sticking with your forecast of $86 per barrel for crude up until December this year. Why do you say that, considering that growth data is coming in so weak?
Yeah, thanks a lot for having me. It's absolutely correct that oil prices have edged down somewhat over the last few days on the back of renewed growth concerns coming out of Europe and China. That said, in the prior 7 weeks, crude oil prices, Brent prices rallied by about 15%. And at this point, we're quite a bit closer to our year-end target for Brent of $86 per barrel. Two reasons really why Brent has rallied for most of the summer. Number one, we think that the global oil market has finally returned to deficits after a year of surpluses. We returned to deficits both because global oil demand, we think, reached an all-time high in August of above 103 million barrels per day, and because Saudi Arabia cut production in July. Second reason for the rally is that macro sentiment among oil investors, which was excessively pessimistic for much of the year, has normalized and has recovered along with positioning. From here, we expect only modest gains because we believe that the oil market will remain in sizable deficits worth almost 2 million barrels per day on average in the second half because of robust demand growth, anemic U.S. supply growth, and strong supply discipline from OPEC+.
Okay. Daan, I'm going to come back to oil market fundamentals of demand and supply for 2024 as well. But before that, the big event that's staring at us in the face, the Jackson Hole speech from the Federal Reserve Chairman, Powell. What is the base expectation and what can move the needle for the crude market?
Yeah, so our Goldman economists don't expect any major change in messaging from Chair Powell, in part because we still have important data releases ahead of us, including jobs numbers and inflation numbers. I think big picture, the message will likely be that the Fed is going to stay focused on bringing inflation down. But at the same time, this urgency to hike, we think, has dropped significantly, both because the level of the funds rate is now quite high, and because we have made very substantial progress in terms of core disinflation.
There is, of course, success in core disinflation. But what's the Goldman view on growth? Aren't recent U.S. economic data still pointing to a fair degree of resilience? What's your own estimate? Does a soft landing look still very likely?
So the Goldman House view has been for a while that the U.S. economy is on track for a soft landing, and the confidence in this constructive, out-of-consensus view has really grown significantly over the last few months. We now believe that the probability that the U.S. economy enters a recession in the next 12 months is just 20%, well below consensus. Three reasons for constructive growth views, where GDP growth is just above 2% this year, just below 2% next year in the US, because of solid momentum, because the fundamentals look good, the real incomes are still rising, and the drag from monetary tightening on growth is actually fading. Oh. And so if you combine that with all the progress on core disinflation, which eliminates the need for the Fed to hike further in our base case, putting that together, I think it's a pretty solid case for the soft landing for the U.S. economy.
Okay, that's also a pretty solid case for yields remaining high. So let me come to that, Daan. Though you would be looking at crude prices, crude prices are willy-nilly influenced by the U.S. yield level as well as by the strength of the dollar. Now, what has surprised financial markets, or so it seems, is the very sharp rise in U.S. yields in the month of August. 3.5% in the 10-year in June, 3.7% in July, and 4.3% in August itself. What is your sense? Do you think that even if core inflation data came in lower, yields could remain higher because of what Fitch pointed out, continued high fiscal deficit?
Yes, so our rate strategists had been looking for a while for the U.S. 10-year yields to rise to around 4%, both because we viewed the pricing of cuts in 2023 strongly related to the consensus view of high recession risk as excessive, and that cut pricing in 2023 has significantly reduced. Second, we have been skeptical for a long time now about this idea that the neutral rate, the long-run equilibrium interest rate, is as low as markets believed it to be in the last cycle. And as you point out, on top of that, larger fiscal deficits in the US, but also in most other major economies, should put some upward pressure on term premia and on long rates. That said, we believe that the rising rates has now run its course, both because we believe that investors may be overestimating the impact from increased treasury issuance, and because we think that the BOJ will not exit yield curve control for the remainder of this year.
Okay, got that. So your rate strategist is estimating 4, but maybe 4.3 will not hold for too long. Okay, time permitting, I'll come back to that. Are they also expecting a strong dollar to continue? I mean, we've seen dollar go north of 103 from sub 99, the dollar index, that is. Does the dollar remain strong? Because that will be an impact on crude prices.
Yes, absolutely. A strong dollar reduces demand for oil and commodities more broadly outside of the U.S. because most commodities, including oil, are denominated in dollars. The dollar view of Goldman Research is nuanced. Big picture, we're looking for shallow dollar depreciation. Shallow because the U.S. economic outlook is still solid. And we expect the Fed to keep rates at current levels until probably the second quarter of next year. I think the main reason the dollar has appreciated over the last few weeks is renewed growth concerns coming both from China and Europe.
Okay. Well, now let me come back to your crude forecast for next year. Considering that the U.S. economy also is going to slow down and China is not really living up to the promise of even normalizing growth, shouldn't crude trend lower in 24? I think your forecast for 12-month forward is even over $90.
Yes, so we look for crude prices 12 months ahead at $93 per barrel for Brent. The main reason that we expect oil prices to edge somewhat higher really is that we expect the oil market, which is now in a very large deficit, to stay in a sizable deficit next year, worth around 600 KBD on average for next year. Why do we look for somewhat tight oil markets for the next 18 months? Number one, we look for solid oil demand growth. In fact, we expect global GDP growth to equal in 2024 to equal what it is this year, around 2.5% in both years. So we're not really looking for a slowdown. And on the supply side, we think that U.S. production will grow at only a very anemic rate because of strong capital discipline in the sector. And last but not least, we think that OPEC pricing power is greater than it has ever been. And so Saudi Arabia and its partners, we think, will only very gradually bring barrels back to the market. And we'll only do that if prices move in line with our expectations. And of course, also if prices were to exceed our constructive forecast for oil prices.
Okay. Well, that's not exactly good news for a country like India, which is a net crude importer. But be that as it may, just a few more shorter-term questions. You said your range, your your crude forecast for December is $86 per barrel. But what is the range? In the meanwhile, can we see the current downturn take it even below $80? What's a likely range for the rest of this year?
Yeah, so we think that the likely range for oil prices this year is sort of 75 to 95. We think that volatility in oil prices, which has come down sharply year to date, will remain fairly muted. On the demand side, because we think that recession risk is lower than widely believed, and on the supply side, because we think that OPEC Plus and Saudi Arabia will really manage the speed at which they bring back barrels to the market as a function of fundamentals and as a function of prices.
Okay. Thank you very much, Daan Struyven. That was most useful a conversation, not very helpful for a net importer like India to hear that crude would go to over $90 next year. But I think what's music to our ears is that Goldman Sachs expects growth to continue to remain into 2024, at least as strong as in 2023. Jackson Hole, of course, the base case is that Jerome Powell will not sound more hawkish than the market is preparing for. Any specific words we have to watch out for, Daan, from Jerome Powell?
I think a big question is whether we get any signaling on the bar to keep hiking in terms of inflation numbers or perhaps any upside risk from a reacceleration in growth above trend.
Okay. Oh, yeah. We'll watch out for that. Thank you very much, Daan Struyven, for spending time with us. Well, that's the word from the expert from Goldman Sachs. Let's watch out. What is the bar for hiking rates? He did not say the bar for cutting rates at all. Now that's out of the question. Bar for hiking rates. We'll watch out for that on Friday evening, our time. That's it on Bazaar. Up next is Chartbusters.